Hello, everybody. Thanks for taking the time and welcome to the Monetized Advisor Podcast brought to you by JPTD Partners. This is the podcast where we talk about all things how financial advisors grow, protect, and ultimately monetize the value of their practice. I am Peter Velarde, one of the founding partners, and I am the P in JPTD. Very excited to have a guest with us today. We don't always do this, but we have got one of the best advisor coaches we know in the industry, Kristin Andree, with us. And we're delighted to have you on with us. I checked out again your LinkedIn profile, though I've known you for years. I love your tagline: less noise, better decisions, exceptional businesses. And it's all about transformation. Just love how descriptive that is. Perhaps you can just give a quick intro and let our folks know who you are.
Yeah, thank you. I'm excited to be here because I've known you guys forever. You guys are the best at what you do, and I'm excited to get to chat. But background on me, I'm a recovering advisor. So I've run a firm, I've run a practice, but my heart and passion is helping advisors scale and grow. But you mentioned it in the tagline. I think in our industry, there's so much noise, and no one knows what to pay attention to. So they
Mm,
just grab the next shiny object or listen to an idea they heard from somebody in their study group or someone at a conference. So my job is to really help them cut through the noise and figure out what works for them and their practice as they're scaling and eventually exiting.
that's wonderful. And boy, there's a lot of noise out there right now,
So
and the
much.
sand is shifting. So we use these opportunities to educate advisors, both pre-transformation, during the transformation, and then help them understand what to do when it's the right time for them to actually take some chips off the table and bring in a capital partner. So uh,
Absolutely.
today, that's what it's all about. The main focus of today is really the concept of scaling beyond yourself. So we're going to be talking about growth strategies after you gain a capital partner. But the reality is, for those of you that are saying to yourself, well, I should shut this off because I don't have a capital partner, all that we're going to talk about is going to be highly relevant to prior to a time when you might monetize with a capital partner. All the things we're going to talk about post monetization are going to be highly relevant to you prior. And that's why we brought in Kristin today to help us do that. Agenda wise, we're going to first do an article review, as we always do. Makes it fun, gives you perspective. So we'll kind of bat that around a little bit. The topic there is going to be this concept of independence. So you can start thinking even now, what does independence mean to you? And we're going to kind of give you our perspective on how the industry has changed. I've been in this space for 44 years. Like Kristin, I was a CFP, financial advisor. I hired and trained thousands and thousands, led groups of 5 to 10,000, and then did my entrepreneurial thing for the last 20 years. And that's led to just a fantastic opportunity to help advisors come full circle, where if they listen to us, and we didn't hurt them too bad, they went on to great success and found now themselves being in a position where they can say, hey, I'm probably worth, my net worth is probably 80% or more tied up in my business. I want to grow faster. I want to get things off my plate. So advisors come to us to help them make proper and informed choices about what all that looks like. So that'll be the bulk of today. We're doing an article review. We'll get into the bulk of the main content and have a discussion on it and try to add as much value to you as we can. Then the ever popular section where we review an offer with you will be kind of the last thing we do. We'll actually walk you through an offer, an LOI recently signed by one of our clients to give you an idea of what these deals could look like, and then we'll kind of wrap things up. So that's our story, and we are sticking to it, Kristin.
Sounds good to me.
So let's talk about this notion of independence. The article I'm going to cite was in CityWire. If you want to pull it up, it's an opinion piece. This was as of July 29th, and the opinion is the question: what does independence actually mean? And it's from Adam Malamed. who is chief executive for Sanctuary Wealth. He writes it. And, what I liked about the article, Kristen, is that it raised as many questions as answers. And, as you think about this whole world of independence, when we talk to advisors throughout our process, it is one of their top values, and it's one
Mhm.
of the top requirements of a deal. They need to at least feel more independence, but independence means different things, and it probably is changing in terms of what it means to people. But how do you get your head around, as you coach advisors, what are you finding independence means to them, and how have you seen that changed over the years of your coaching?
Yeah, for sure. I feel like I think for all of us, it used to mean ownership. Who owns it? Like, what's the structure? So if they
Mm,
wanted to go independent, it was because they were tired of being, owned by somebody else. They wanted to, not stick it to the man, but they just want to be their own thing. So I think it used to be ownership, but now the conversations I'm having with advisors are more around optionality, control. Like, what's branching out, being independent means like, do I have more control or do I have less control? Am I losing it? Or is it creating more options, especially, with the capital coming in? It's what does that create for me? So I think we're starting to see people look at it completely different than we did 15, 20 years ago, for sure.
Yeah, I think that's accurate. We're seeing the same thing. I think back to the days where there was a massive movement, probably the biggest movement of advisors was from kind of these captive employee wirehouses and
Hmm.
banks. This
Yep.
whole world began to open up for them, the independent BD world or IBD
Yeah.
world, where they perceived they would be super independent. And they kind of did it because they felt more in control. They
Right.
had more access to things they couldn't get within those ecosystems. What's interesting to me is that now the biggest movement is from the IBD communities, some of the insurance ones, some of the big names we all know.
Hmm.
Now it's kind of the thinking that, man, the most independent space is this open architecture RIA or RIA hybrid systems. Are you finding more interest of your people to kind of say, I need one last step to become unbridled, to be completely independent,
Yep.
um, and to, have access to things like alt shops and things like that? Are you seeing the mindset of advisors beginning to shift more towards at least exploring that, and often, especially today, exploring it through a capital partner?
I absolutely. I mean, and I feel like it's, what's been interesting in the discussions I have, because usually when advisors are reaching out to me, it's because they're, I don't want to say disgruntled, but something's not working where they are. They're
Mm,
not getting what they need. And, so it's less, as I mentioned before, less about ownership and more like, I'm here, but I am handcuffed. So
mm,
I'm starting to see people look at like, where can I go that I feel like the things holding me back from growing my practice, or the things holding me back from serving my clients or growing my revenue. That's what they're looking for, whether it's technology, leadership, marketing. There's a lot of different things, and they all come to me with different reasons, but it's usually because they're not able to do what they want to build their practice. And it's not about, ego or anything. Usually sometimes it is, but usually
mhm.
it's just like, I need some more optionality here. I can't get to where I want to be with where I am.
Yeah, there's no egos in our space, right?
None at all. None at all.
Yeah, and look, we all worked hard to build a practice. We had to do hard things for a long time period. We had to
Yep.
do the right things for people, and all of that. You start to feel like you start to get in control, and we go
Mhm.
from that survive phase to the grow phase. Working with people like you to the scale phase, and then once you
Mhm.
scale, then it's time to think about monetization. So
Yep.
so you can see why people do have a high opinion of themselves if they can make it through that cycle. And I get that. We were way more kind of arrogant and confident in our youth and our warrior days. You learn as you get older that there's way more that we don't know than we know, right?
Well,
Um,
those stages are different. The needs of an advisor at each
that's
stage of
right.
growth are very different. I think it humbles you. I think, the advisor that's making 500,000 versus 5 million is very, very, very different.
Yeah,
And it,
for sure.
This business humbles you as you go. I get less egos the better you're doing, honestly.
Yeah,
They
we find
realize
the
it's
same.
like, this isn't all about me. So,
We find the same thing. We just talk to so many great humans now that have been through that process and are
mhm.
eager to learn and grow. But this
Yeah.
whole idea of independence is fascinating to us. We have pretty intimate talks with our clients about what that means to them. What we're hearing about this is very much like what you're hearing. We're hearing, I want to control decision making. I want to be able to make the calls on my staff. I want to have a vision that's honored and supported. I want a certain culture. I want to maintain this great culture that I've built. I want to have values alignment with whoever my partner is, whether it's a
Mhm.
capital partner or existing partners in my firm. I want the values to align. So it's more about control than ownership. It's more about how they feel, and it's also a lot about how they operate. And this is probably one of the biggest fears that advisors have when they come to us to say, "Hey, look, I'm at a point where I've grown a lot, but I have some unique needs right now. I see that the M&A environment is peaked out in terms of valuations. I see that all markets are up. So it feels to me like there's ever a time to take some chips off the table. It's kind of like the peak of the real estate market. If you're going to sell your house in the next few years, there was a period of time that would have been the
Mhm.
time to do it. It's feeling to all of us like that's the time right now. So they're seeing that. They're also seeing in various ways, they're all hitting the ceiling of complexity, and they're not quite at their highest and best use. And they
Yes.
know if they can get there, it's going to lead to a much more productive practice and growth as a business. A lot of people are concerned about business continuity, and they're coming to us saying, I may have a G2, I may not have a generation two advisor, but I need to firm all that up because if something happens to me, I want to make sure my clients are taken care of. At the same time, that there's this big kind of wealth transfer that's stuck between generation one and gen two,
Mhm.
where even if somebody has a gen two advisor, they're kind of saying, I don't think they can afford to buy me out because
Right.
valuation of my practice used to be 2 to 3 times revenue. Now I'm hearing it maybe 4 to 8. And so I either have to take a big discount to get it to them. So they're trying to solve for that.
Yes.
So these are going on. Do, do you think that there's a difference in your mind between independence and freedom? And I'll share my view on it. But what we're trying to help people see is that post deals, the deals that we do, and we see a lot, we do more deals than anybody. We see advisors who sense fear before they do a deal because this whole
Mhm.
thing, I don't want to let go of things, control, and those
Yeah.
things, not knowing what these deals look like. After the deal, they find, wow, I have all those controls still. The company's buying me because they want me to run my practice, run my business.
Yes.
But now I feel this new sense of freedom. I've got more time in my hands. I'm doing highest and best use.
Mhm.
Compliance is off. I've got some support for operations, so that's off my plate. So, do you think we need to, better educate advisors on, what does independence mean to you? But
Right.
really, what most people want is they want more freedom
It's freedom.
because they want to live a certain life that their practice provides for. But what do you think about that idea between independence and
I
freedom?
think I love both terms, and I think they're completely different. And this is where, you guys do a really good at JPTD. You guys do a really good job at this because when an advisor comes to me and I'm trying to help them scale, used to be the people, especially the buyers, are like, "We'll pay this valuation or this multiple or this that." It's really not the biggest thing most of my advisors are worried about. They are worried
Mm,
about that difference. So independence to me means is where you're going. Freedom to me means what you're gaining.
mm,
And that's where the questions are. That's where, if I'm talking with an advisor, it is things like culture. What G2 are you putting in place? What happens? I think the bigger question for me is I don't want to know, whoever, whatever partner you're taking on or firm may acquire you. I'm less concerned with multiples, very important, but I'm concerned with who'd they buy 3 years ago? How are they loving it? Are they
mm.
enjoying what happened? That's really where the questions need to be. Because to gain true freedom, you have to make sure you've asked those questions way ahead of time. And I think for a lot of advisors, that's the piece they forget to ask. So that, and you guys do an excellent job of coming in and saying, all right, what's important to you? What do you want out of this? What do you want your next chapter to be? But the advisor has to be able to define what freedom looks like for them. And it's different for every single person I meet with. So I think that affects like
Mhm.
what offers they're going to entertain too.
And that's why every deal we do is completely bespoke. It's really about
100%. Yeah.
out of the 120, capital acquisition partners that we've already done the vetting for,
Mm-hmm.
which five or so represent the cultural and values match for our client
Yes.
from what we now know about them. And it can, I'm sure you find this too when you coach a ensemble practice that may have more than one principal. The
Yes.
principals may have different goals and thoughts about
They
what.
usually do. They,
Yeah, and sometimes they
they
agree,
form
sometimes.
these practices without asking themselves the same question. So,
Yeah, yeah. So I think your point's a great one that this requires conversation. And it requires conversation early and often about what independence means to you and your partners, and how is that best achieved through the next best and last strategic partner that may be a capital partner.
yeah.
And we spend a lot of time to vet that out, and we
Yeah.
want to make sure it's a great fit. But generally speaking, people come in with the fear of independence.
Mm-hmm.
And to somewhat, it's a myth of post deal, somebody's going to tell me what to do. It's actually quite the opposite. These firms are private equity, family office, sovereign wealth, private capital backed super RIAs, where the principals are fiercely independent. They
Mm-hmm.
don't want to lead you, they don't want to do anything other than get things out of your way and off your plate, because they're buying you or making an investment in you because they see the inherent value in what you're doing. They just want to help you do more of what adds value to the valuation, not things that are not your highest and best use. So the fear is real, but one of the things you said that jumped out to me, Kristin, is that we pretty much insist that they do speak to advisors in their
Mm-hmm.
culture. They do speak, that they visit, shake hands, meet the people
Right.
that they're going to work with. Because post deal, it's all about expectations set versus realized,
Yes.
and we want to make sure they have a chance to fully vet out on their own what the culture is. So fear, but don't be concerned about it, I guess is the headline.
Yeah.
But do define it for yourself, and then allow us to help you find the match that best supports it.
Well, and I
And
think the match is going to be a big thing, Peter, because a
Mhm.
lot of times I'll hear an advisor where they are approached by a particular company and it may be a great firm. But if that is the only thing they're looking at, we can square peg round hole all day. They're going to make it sound
Mhm.
like this is going to be the best thing for you. And I personally think advisors do a disservice if they don't have an advocate in their corner saying, let's look around. You tell me what you want and let's go find that, as opposed to the company saying, here's why we'll work for you. So I do, the approach that you guys take in terms of having 120 different potential people that you could approach, you weed out, I'd say, I'm guessing a large majority of them just based on what the advisor is telling you they want. And I think that's critically important because advisors will assume that I have to go here, I have to go there. I'm like, see what's out there. Plenty of fish in the capital partner and acquisition sea out there. So it's important to kind of know what you're looking for so you can go find the right fit. It's
I think
alignment way more than acquisition or capital to me.
it really is alignment. It's not just the deal or the deal terms. It's what does the partnership look like? And what's the best category and what's the best firm? Just to close us off with, I guess, more of a teaser, part of the calculus that we go through with our clients is what category of potential partners is best. For example, on one end, you may have aggregators, which will kind of say, hey, we've got this menu of support. You get to choose what you want to use. On the other end, you might have integrators that say, actually, our best value to help you scale is for you to switch over everything you're doing to what we're doing. And there's kind of shades of gray between those two. So it's what mix of control do you want versus the mix of scaling and independence. Most people find that when they try to scale and have disparate processes and systems, they can't. because if
Mhm.
they got, if all your advisors are doing something different, it's very hard to scale. So that there's this kind of trade-off that you need to understand of what's best for you at a moment in time will depend again on what your goals are, what's important to you, what you value, and what culture is going to best support it. So, great stuff. Anything else on the concept of independence, Kristen?
I think, I mean, those are really the big things. I mean, independent, it can be really really good, but you got to ask the right questions. It'd be like, I've got three girls. It's like if I just didn't teach them anything about the real world and just said, okay, you're out of school, out of college, go off and do, it wouldn't work. So I think you've got to really, before you're think you're ready, need to start thinking and asking and figuring out, what does independence or freedom look like for me and for my
Very good.
team or my practice. You got to start that way before you think you need to.
Yeah, sort of like what our advisors we work with do for their clients, right? It's like you don't want to
Exactly.
start talking about retirement when you're a year or two away from retirement. You want to be talking about it now,
Right.
whenever that now is in your life cycle. So,
Yeah.
same kind of thing. Okay, good. So let's kind of role play a bit in a sense and kind of say, let's put ourselves now in the shoes of an advisor. And they've worked with somebody like you or with me in the past, and they've built a practice, they've scaled a practice, and now they have accepted a deal with some capital partner. It might be minority, majority, full deal, but it's a capital partner that can do those things that we've been talking about, get things off their plate, help them de-risk, help them form a succession plan, help them achieve their highest and best use, grow faster, maybe start doing inorganic growth with capital, maybe tapping into the operational infrastructure of a company, maybe tapping into a marketing department that can help them boost their client acquisition. So it's that kind of person we're talking to both before and post transaction. In your mind, what's most important to that scaling. One thing that comes to mind for me that we can start to bat around a little bit is this concept that the capital that now is there and the infrastructure, that alone is not a strategy. That
Agree.
exists to accelerate your strategy. So it's important that you've
Right.
got a strategy prior that allows you to scale in a predictable way. When is the ideal time for somebody, for example, to come to you and say, I'm ready to now scale, and I need to put the infrastructure and systems that depend less on me? At what point does that happen? And then tell us a little bit about kind of what that conversation looks like. How do you coach them to help them see what scaling could look like, and
Right.
then what the kind of ingredients to the cake need to be, per se?
Well, and I think, I mean, there's yesterday is the best time, obviously, with any stage of growth. But I would say once everything is dependent on you, so the easiest question is, could you leave for 6 months and the business still run? Could you leave for a year and the business still? If it can't, it is way too dependent on you. And that's where we need to look at processes, people, leadership, everything, marketing, all of the pieces. So I think that's really the first thing to look at. Is most of us come into the practice because we love it and we grow it, and
Mm-hmm.
we are the kind of the cog that keeps it stuck sometimes. So we're the reason it grew, but we're also the reason it plateaus. For
Mm-hmm.
me, my favorite person to get is an advisor who is very successful but has been on a little bit of a plateau or just a tiny increase year over year, because it means they've something stuck, and the cog in the wheel is usually the advisor or the leader. So
Mm-hmm.
that's probably the best time. But as we're looking at different sizes and different practices, most people are doing what they learned to do. We did all things, right? We came in, you and I started the same. We come in and you do all the things, you run all the pieces of your practice. But advisors rarely, once they grow, stop to figure out, what's my strength, what's my best and highest use. If they haven't done that, we've got to pause and figure that piece out, because we can wrap everything around it, but we need to know, what are you really good at? What are you uniquely qualified to do? What do you get excited? For some people, it's planning. For others, it's portfolio management. For some, it's, I like to be the rainmaker and be out meeting the people. So there's no wrong answer, but if we can't figure out that piece and slot the person in there, we start to stifle the growth a lot. So, and that's important as you're looking for a capital partner or anything, is we've got to build around that. And that's
Mm.
the piece I think most advisors don't spend enough time on.
Yeah, it's interesting, right? I'm smiling because for 44 years I've been doing this. This kind of idea of highest and best use,
Mhm.
this kind of idea that less is more. So if I'm doing 10 tasks today that I think add value to the business, if I were to prioritize those 10, I probably could come up with Pareto's law of the few that drive 80% of the result,
Yep.
that I have a gift and a passion for, that I would want to do more of. And
Yeah.
it's so interesting. As soon as advisors get that is when I saw big growth. And sometimes that
Huge.
meant teaming, sometimes that meant
Mhm.
staffing, sometimes that means bringing a partner, sometimes it means bringing in a Gen 2 advisor to take your lowest value
B's
100
and C. Yep.
clients
Yep.
off of you, and you just work with your highest value in segment clients. But as soon as advisors get that, is when you just see this hockey stick type
Yeah.
growth. Um, but
It's huge. You mentioned segment. I love a good segmentation. But
yeah,
what's funny is I'll talk to a client or an advisor and I'm like, "Have you segmented?" They're like, "Yes, I have segments," and they'll tell me their segments. And then I'm like, "Well, let's pull out your calendar." And they'll be 70-80% of their time in front of B and C clients. And I'm like, "You just told me these are the people you want to work with, but your activities, your calendar, your priorities don't reflect that." And I think most advisors, if they really are honest, that's why they're in the way. They're trying to be all things and do what they did to get them to here. But we want to get them a lot higher. So,
yeah, I think there's kind of two important subparts to that. Part one is how you perceive yourself, right? If you perceive yourself as a practitioner,
mhm.
financial advisor, your uh, dominant thoughts and actions will be one thing.
Yes.
If you see yourself as a business owner building an enterprise,
Hmm.
that's when you'll be thinking scale, things
Yes.
not depending on me, building infrastructure, building redundancy, all those things that any business, widget firm USA, for example, would need to do to scale. So let's shift into infrastructure.
Sure.
What systems have you seen, Kristin, in the work you've done preparing somebody for an exit or somebody that already has exited to make sure they're executing with this capital partner? What are like the minimum infrastructure systems that they would need?
It it's going to be an odd. It varies. I'm going to go back to kind of that highest and best
Mhm.
use because I have some advisors who truly love, like, I'm the planner. I want to be the planner, but then we have to hire around that. Meaning, if they're lousy at being the CEO, then we need to hire a CEO, COO, president, somebody to run the business side of it. But
Mhm.
they may be good at the business side, then we need to handle somebody to run the planning side. But what I see from an infrastructure standpoint is something that is not dependent on the advisor, the one owner. So we've got to look at, like, how do we complement what you're bringing to the table? So I would say, I mean, I've seen very, very successful practices and firms that may have one advisor, maybe one junior, and I hate to say an admin because they're really truly like the glue. I call them the glue. I have a couple of my advisors that's literally what I call their main COO or admin, is like, that is your glue. We need that. So I don't think there's a right or wrong for infrastructure. It varies, and I've had other teams that I work with that have 25 people on them, and they both work, but the key is get the right people on the bus first.
Mhm.
I like if you read any of John Gordon's work, he talks that book, The Energy Bus. Get the
Mhm.
right people on the bus. Get the people who match your culture and your values and your drive and your ambition, and then we find the right seats for them. But so I think if you lead with people, and then we get people, leadership, and then processes in that order.
Yeah, I think that's so true. Talent is everything. Right people,
Mhm.
right seats, right bus, going in the right direction, led by
Yeah.
somebody who can drive the bus. All of that is
Yep.
really important, and that's the way a business owner would think, right?
Yes.
If you're thinking like a practice person only, which is fine,
Right.
plenty of wonderful people out there just They've just chosen to build a practice, not a business that scales, and that's fine.
Exactly.
It's not going to be worth as much in the end,
It won't.
but
No.
but that's okay. That's okay as long as you're accomplishing what you want for yourself. There's nothing wrong with that.
Well, and
So,
that may be a good person to align with somebody. You may
no
have one. I've
question.
had teams before where I have one that's a great business owner, and then I have one that's a great practitioner, and that may be a beautiful, beautiful combination.
Yeah, that's absolutely true. What we kind of look at when we look at it from a buyer's perspective and say,
Hmm.
okay, what would a buyer, what systems would a buyer need to see in place? Some of the
Yep.
things that come to mind, there's kind of the retail distribution concept of you grow through more stores times more productive stores and more profitable stores. So do you have systems to grow your staff, your talent, your advisors, and are you doing it organically through, let's just recruit talent? Do you have a talent development strategy to help build the talent from within and get referrals from within because your culture is so good? But firms are going to want to look at you and say, I'll value you higher if you've got a business with more than one seat on the bus that are filled by high talent. So what's your, recruiting and talent dev function? That's one they look at.
Yes.
Another one, of course, is the leadership of the firm.
Mhm.
How big is big to you? What do you want to accomplish? What's the vision of it? Your tech stack is important to them in a few
Yes.
ways. One is that could there be synergies between your tech stack and their tech stack? Put another way, could you have a lot of cost saves together to use their scaled tech stack that may be the same as yours and just better pricing, for example?
And same with
Uh,
marketing. The marketing stack
same
is
thing, yeah,
really
and
important. Yeah.
that's another area. Really, what a buying firm is looking at is if I buy some or all of your net cash flow as a business, which is what any business in the end is buying, some version of EBITDA,
Mhm.
EBOC, free cash flow, and what they're going to do is they're going to say, yeah, I think that this is predictable in itself, but with us, I think we can, double, triple the growth of that cash flow together, and everybody win. And that's so they're trying to look for systems that you have in
Yes.
place that don't depend on you. The
Yes.
more it depends on you, the less it is worth to them. And that's why that question we ask our clients: if you left for a month, would you still grow, not just maintain?
Yep.
Because we believe you're either growing or you're dying.
Yep.
I've yet to see a practice that during all ups and downs in the marketplace that says we want to maintain. I've yet to see one grow
Exactly.
or even maintain, right? Um,
I make
so
them leave for more than a month. I'm like, if you left for 6 months or a year,
yeah, I like yours. We may change
yeah,
ours to 6 months too.
yeah, I like
I-
it. But
it's
it's
very
true, and
important.
that goes to what you said earlier with recruiting and development. I see a lot of firms recruit good talent, right?
Hmm.
I do not see a lot of firms develop that talent once they're there. And that's a huge opportunity. I like to get in if I'm taking on a new private client and I'm looking at their firms, I want to meet with their G2, their G3s. I want to meet with all their admin because most of the time the main advisor, the owner is frequently really unaware of their potential, what their challenges are, what they're struggling with. So you've got to develop them. Like we do a great job at pulling people into the industry. Still some room to grow, but we don't always do a great job once we get them. So I think the development, I'm wanting to see how are you growing these future leaders?
Hmm.
How are they, if you retire tomorrow or you take off a year, are they you? Are they kind of, a mini Kristin that's going to run around and be able to carry on what you've built? Because most of us, you said 44 years in the, I'm only 26. So 44 years, I've been 26 years. You've been 44 years in the industry. We want to know what we built. Like we've sacrificed a lot to build our businesses. We want
Hmm.
to know that's going to be carried on. And I think advisors are selling themselves a little short by not developing who they have coming up behind them.
Yeah,
Huge
I
opportunity.
think we hear the word legacy a lot as it
Mhm.
relates to kids that may come up in the business or
Yep.
not. We hear people seeking higher meaning than just money. once they
Mm.
kind of hit what they think they need.
Yep.
We hear a lot of that, and we flush it out to find out what exactly does that mean, and we help them see both the opportunities, but also help them see the risks, because
Yes.
the sand is shifting a lot in terms of industry consolidation,
Mm.
the
Huge.
wealth transfer from G1 to G2 being stuck, shortage of financial advisors, the AI relevancy risk, the fact that everything is peaked out, and how will this world change? Your practice that may be worth 6 times today, midway through next year with a market correction, could be worth
Yep.
4 times. That's millions of dollars that you left on the table. Just like if you happen to be fortunate or smart enough to sell your house at the peak of the real estate market,
Mhm.
where you would have been there versus if you waited 6 months to a year is very different. And so,
But that's why it's important, I think, for advisors to start asking questions. Like when you said, when's the time to think about this growth? It's yesterday. I want to know, ask these questions now because I mean, I know I've sent people to you guys before. We've talked to about certain potential advisors that I work with that you're like, they're not there yet. They're not ready, or let's hold out. You guys are going to tell them one way or the other because you know the landscape. That's where I'm like, that's me. I'm like, I can tell you how to grow the practice. We just need to figure out where we're going, what we're growing it for, what's our in game legacy, if you will.
I think that's the headline. I think the headline of all of this, when you start to enter a capital partner into the equation and somebody transacts with who they think is the best and last partner, in whatever form it may come in, that's right for you and kind of bespoke and structured around
Yes.
what you want and how you want it. Once you get to that place, I think the headline is that all of the strategic planning and infrastructure needs to have happened prior to that. And
Yes.
then what you want to do is not give that up in a transaction. Quite the opposite. What you want to do is look for the right culture, values, and infrastructure that complements it and accelerates that
It
strategy.
enhances it.
Uh,
Yeah.
and
Yeah.
what we know, for example, is post transaction, our clients grow an average of 2 times faster than they did prior. You almost have to when people get things off your plate. And if you take any of that extra time and invest it in a little bit more of your highest and best use, but then there's all these growth drivers like capital. These firms have completely wired M&A departments, and so our philosophy has always been from the sell side, the people who we love, advisors that we represent only. We don't represent the buy side. We only represent the sell side. We believe you should have the representation that the buy side has. They have a complete M&A departments. So when you
Yes.
go to negotiate a deal, if you did that on your own, you're severely handicapped because it's you versus a department of M&A experts.
Yes.
But when you now are on the other side, you can leverage that infrastructure. On your own, you might say, I don't know how to do an acquisition. I've always grown organically. That's been great. But, I've had
Mhm.
people coming to me saying, I want to maybe be part of the special thing that you've built, right? But you don't have the capital. You don't want to go into debt. You don't want to hock your house, and you don't have the M&A expertise that's
Correct.
very specific to the industry. And now you've got this infrastructure and that group that you had to kind of compete with to get a deal done. Now you're on the home team, and now you've got
Mhm.
this support to help you do that. So, I think the headline is work with somebody like Kristin, prepare for the transaction, and then work with somebody like us just to make sure that the fit is right with the company you're talking to so
Right.
that you can not only preserve it, but accelerate that. Any other headlines for you,
It's,
Kristen, in this
and I
discussion?
think I keep coming back to the word you said, bespoke. I mean, that's
Mm,
really at the heart of it. And, I kind of tell the advisors I work with, I am so customized and it is bespoke type of consulting because what's going to work for one advisor, one practice is not necessarily what I'm going to recommend for somebody else. None of my clients are the same.
mhm.
They may have similar revenue levels or similar companies. Even within the same companies, they're not the
Right,
same,
right.
but it's, you've got to take that bespoke approach to it or you're going to end up being shoved in the wrong place, both from a growth strategy standpoint and a capital partner acquisition standpoint. You've got to make sure that you're taking the time to ask the right questions. And since we know advisors don't always know the questions to ask. That's what we're here for. Whether it's growth or, bringing on a partner, it's, you got to know what to ask, and let us, I ask a ton of questions. I kind of joke the first time I meet somebody, I'm like, I'm going to ask a lot of questions. You're going to be tired of me asking questions, but I need to know everything I can possibly know to find the right growth strategy. And it's the same thing with JPTD, is y'all do ask a lot of questions, but it's to
Mhm.
make sure the alignment is there. So I think bespoke and alignment are kind of the two things I feel like are the biggest opportunity for advisors that,
Yeah.
on the growth side or the acquisition side, that they need some help with.
Yeah, I think so too. And I think at the end of the day, all the juice is in the questions. And we spend an inordinate amount of time coaching our clients about what questions to even ask when we
Mhm.
start to date these firms to flush
Yes.
out if it could be a good fit. For example, I coach my clients on the three must questions you must ask a buyer.
Okay.
And that's important. It's important for you to know what those things are maybe the next podcast or two that I host, I'll get into that a little bit more.
Yeah.
Make sure you understand what those will be. But I do want to jump to the final part of today's podcast. It's always interesting for advisors to hear real, actual offers. We operate in a world of transparency. We want you to know everything so you can make informed choices. So this is a practice. This is a ensemble type practice. They are doing, and I'll just kind of walk you through this real quick, and then I can get Kristin your reaction to it and what you may have learned, and uh, give you a few headlines, and then we'll wrap things up. But so this is a ensemble type practice, and this is a full acquisition. So this is one where they felt the best fit. We don't really care what you do, whatever is best for you. We have no horse in the race, and we want you to be informed about the differences of different partners, different type of deals. But this is one where it was best for the client to do a full acquisition. And this is with one of these super RIAs that have scaled. Their equity is worth a lot and will be worth a lot more down the road, that are backed by, call it some capital source, private equity, family office, private capital, sovereign wealth, that have already taken a bite of their apple. And with it comes a tremendous amount of capital for them to do two things usually. One is to expand the client deliverable to compete with kind of this threat of AI, and to be, one of the 20 firms left standing. This is very predictable. This industry consolidation happened in the medical industry, dental industry, hardware industry. This is a predictable cycle, usually lasts 5 to 10 years. And if there's 1,000 firms in the beginning, there's 20 or so left standing. And those 20 own a vast, percentage of the market share. So this is not pie in the sky. This is happening. It's been happening. We're probably in the seventh inning of all this happening. We're about 6 years into this, somewhere around that. Who knows who's got the crystal ball? It's certainly not you or I, Kristin, right?
No, we like to think. I wish. I wish.
Yeah, you know what? I bet we'd still be doing this even if we had it. So because we love what we do. So that's the type of group that this is. So just real quick, this deal came in. This deal, the way these deals usually work, full deals, is you get 50% or more of your entire deal value at the transaction when you close. That takes about 6 months or so from the time that you, for example, were to engage with a JPTD partners. So once you close, there's an amount paid up front, usually in some percentage of cash and equity. In this deal, the amount at close came out to on a 3.9 million rev shop. This came down to the upfront consideration was 21 million and change, of which 70% or 14 million was paid in cash. So at the close, they're going to get 14 million in cash, and the equity is 6.3. So that's about a 70% cash, 30% equity split at the time of the close. That's unusual to get that much, and that's one of the reasons why we like this company. Some of our clients want more paid up front, some want more paid over time. It just depends upon what it is. So we want to get as much air in the balloon as possible, and then we help you push around the air to get the money when you want. Generally, you want to get as much upfront as possible because the way these deals work is like any other sale of anything where they're buying forward cash flow. And you would much rather, of course, get $10 paid today at capital gains rates than $1 per year for 10 years at ordinary income. So just the math and time value of money, $1 is worth today more than it is tomorrow. Let's get a lot of it up front. Let's invest it. Let's get return on it. And let's get more of it pushed into the capital gain pot, not the ordinary income. So this firm gets that. And they said, all right, we're going to support this particular advisor by saying we're going to give you the lion's share up front, which makes it a more interesting deal. So just that amount is 21 million combined. Then they've got most firms have some version of an earnout paid sometimes in year 2, 3, 4, sometimes 5. They keep it real simple. They just have a simple true up in 3 years, and basically they look at your growth, average annual or CAGR over a 3 year, and they project it. So if you hit 10% CAGR, for example, in the third year, you would get another 3.6 million. That same distribution of equity and cash. So if you grew 10% over 3 years, your consideration or deal value would be 24 and change 0.8. That's a 6.3 times rev deal at the 10% growth. If you grew 15%, that would be 29 million in total of that same deal value. That's a 7.45 times rev. And this group, I think, will hit the 15% because they're a growth machine prior to the acquisition. And again, you'll grow more after the acquisition. So that's a very strong deal. I mean, did you ever think, Kristin, that a practice that in our day used to be worth 2 to 3 times rev today could be worth, in this case, 6 to 8 times rev?
I think it sounds like a great deal to me. And the neat, I mean, obviously without knowing the owners, like I'm going, all right, let's hit the 15% growth. I mean, that's very reasonable if the alignment's there, they've got all the systems in place to really grow rapidly. That's a sweet deal.
Yeah,
They
exactly.
didn't have these back in our day.
No, nothing like it. The whole world has
Mm-mm.
changed a
No.
lot in the last 5 years. But wait, there's more, as they say. Um,
Like it.
so that's kind of one bite of the apple. That's the deal value. That, in essence, you can think of as they're going to buy you for what they think the practice is worth today, right? Then there's kind of 2 other bites of the apple that make this really interesting. One is that equity of anywhere between um, 7 and 8 million of equity, depending on whether you hit the 10 or 15%. What these firms do is they do conservative projections, and they say things like, if our equity grew at this rate, it's usually ballpark, don't hold me to it, it's usually about half of what the growth has been in the past. So if they've grown, 30% the equity, they don't want to throw that out as being predictable. So
Right.
they'll use like 10 to 15%. So the conservative estimate of this firm of that amount of equity is that that's going to add another 25 million to your deal. So on 3.9, if over the next 10 years, for example, and what these firms do is because it's a partner model, everybody usually has the same share class of stock in the company. Everybody's rowing in the same direction to create more global enterprise value of the firm that's buying you. And then they want to open up windows for people to cash out every 3 to 5 years or so along the way. This can be super accretive to your wealth. So this could be a $50 million all-in deal, something like that, over a 10-year time period, most of that at cap gains rates. And then the last piece to this is the ongoing payout. Most of these deals, they range between 30 and 40%, and you have no expenses. So full deals, the company usually picks up most, if not all, the expenses, and you get a payout And a lot of people are surprised by that, Kristen, because they're thinking, wait a minute, you gave me my $10,
Yeah.
right? Why would you also give me a piece of that $1? And the answer is that they want to provide you cash flow as well. Some of these deals are salaries plus maybe a growth bonus. We like the payout concept for our clients generally more
Yep.
because that gives you a chance to even get back up to your past cash flow. In fact, most of our clients, 2 to 3 years of superior growth with this new entity, the advisor compensation at the payout, and their payout, what they do is they subtract the opex of the company, what you're going to pay staff, what you're going to pay, advisors, and they give you a 40% payout. In
Okay.
reality, because that the math works out to about a 30% payout. So you're gonna these deals are so amazing right now because
They're
you get your
very
ten
rich.
dollars,
Yeah.
you get your 30 cents on the dollar, and then because you're growing so fast, that payout, because the percentage is fixed by contract, they don't
Yeah.
change payout rates, they don't have a target of these complicated formulas, there's no global admin fee. That's a surprise. It's all completely transparent what the deals are. So
Wow.
I thought you'd find this one interesting. Uh,
I like that one. And I think, because normally I think so many advisors think about, I'm getting close to the end, I'm retired in 5 years, 10 years, but I'm sitting here going, oh my gosh, if I'm 30s, 40s, managing a few hundred million, I've got some complexity that I can grow, but not that fast. I mean, this opens up a lot. They can have capital, they can have income, they can get additional payouts. I mean, it's like the best of all three worlds.
Yeah, we're
Yeah, I
having a
like that. That was a
blast. The
good deal.
four of us, we love working with people like you. This whole thing started on people coming to us saying, thanks for helping us build and scale a practice.
Right.
And the four of us partners, we did this by the thousands. A lot of them start coming to us
Yeah.
saying, we hear there's a whole new world of this beyond the old world of only sell and leave and retire and go to Live Oak Bank and get a business valuation that always come back at 2 to 3 times the rev.
Mhm.
That's not the market. And we create a higher market for our clients, of course,
Yes.
because we create an auction where we compete these five firms against each other to bid for you.
Yes.
So that's why you see these kind of valuations. But we love it. And what we love most about it is at the close when people say, thank you for changing my life again. You brought me in the business,
Yeah.
or perhaps you brought people like me in. That was fun to help people build careers. But honestly, when you see these people, the smiles on their face when they close, and then most importantly, we stay in touch with them and we talk to them a year, 2 years, 3 years. I just had a client ping me and say,
I love that.
thanks, I just got my earnout, my growth earnout that I hit. Thanks for your help in finding the right partner. This has been amazing.
Oh, I
Uh,
love that.
so that's why we do it. I'm sure you find the same thing. Just to wrap this up, Kristen. At
Yeah,
the end of
I
the day,
do, and
it's
it's
so fun to
fun.
see people grow,
Yeah,
right?
it's fun. I love seeing them grow, but now they've grown so well. I'm getting those calls. That's why I partner with you guys because I'm getting those calls like, "What's
Yeah.
next? What do I do?" And you know, most of us grew up and we didn't really know what was out there. I think because it's the landscape's changed so much. So I'm seeing people like, "Oh, somebody offered me 1.5x or 2x," and I'm like, "No, no, 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 no. Let's see what our options are." So this is it's fun. I think it's really and it's exciting to see advisors rewarded for everything they built. So I think it's awesome.
Perfect. Well, let's wrap it up there. To me, a couple headlines jump out to me. One is think about what independence means to you, think about what freedom means to you. The better you can define that, that'll help you implement whatever strategy comes next. Second is make sure you're exploring what your strategy should be to scale your practice. It's a magnificent time to be an advisor. There's more demand than ever. This wealth transfer is going to hit the majority of it in the next 10 years, starting now. And there's a shortage of advisors to be an advisor. Don't fear technology and AI. Just you've got to be in a position where your value to your client expands beyond what it is today. And most businesses simply can't do that alone. They need a larger partner. And the whole idea that you can now, unlike the past, find the right strategic partner that can give you this unique type of support and capitalize your life for you through a transaction is just remarkable. These deals did not exist prior to what we did. They existed in a very small part of what these deals look like today. There's a timing thing here. So there's a window to do it. So have a strategy, work with the right people, both to implement that strategy, like Kristin, work with the right people to make sure you've got good representation. Should you want to explore what it could look like to partner with somebody for capital and for growth. So those are my thoughts. Anything else on your end, Kristin?
I think wrap up, it's the ask the right questions and then find, as you mentioned, find somebody that will help you find the bespoke answers to those questions. So you get alignment above everything else.
Perfect.
It
So
helps out there. Just find it. Yeah.
yep, perfect. And so if somebody wants to reach you or reach out to you to get any questions answered or to explore working with you, what's the best way for that to get a hold of you, Kristin?
That's it. Website, MyFA Coach. Made it easy. MyFACoach.com. I'm also extremely active on LinkedIn. So connect with me there. I love engaging and I share a lot of tips and ideas there too.
Wonderful. You can connect with me on LinkedIn as well, and just go check out jptdpartners.com. A lot of cool things you can do. You can see real offers, real deals. Again, we're completely transparent, so you can kind of pick out yourself in there and say, here's a deal that looks like one that might be good to me. We can also get you a free business market valuation. It's right on the top page of the website. So engage with us. Let us be a resource to you. We are here to help. Kristin, always fun to be chatting with you. Thanks so much for all the wisdom you've shared today. So I guess combined, we've got 60 plus years in the business.
We're doing all right. We made it.
All right. Look, we're still
going.
Still alive, still having fun.
Exactly.
So it's all good.
Thank you,
everybody, for taking the time to listen, and you all have a great day.